taxes and how this applies to real estate.
Welcome to Panama. My name is Pacman. No, sorry, not Pacman, Osvaldo Lau. Okay? My English is not so good, so here is Solima with me, and she speaks better English than me, and she's more beautiful also.
I will try to do as well as the taxman expert over here and try to share with you a little bit of our knowledge in taxes. So, let me see. El botón hacia la derecha. So, sí, Centro de Soluciones Impositivas is a company that specializes in tax advice, tax planning, and fiscal compliance. So let me thank you. So talking about real estate, how to buy, the cost and benefits, there are 3 scenarios where you can buy a property. That would be through a corporation, through a private interest foundation, or in your own name. This is roughly all the taxes that are involved in real estate business in Panama. So if you have a property through a corporation, you will have an annual fee due on the corporation. You will also have property taxes that are annually, an income tax on the sale of shares if you were to sell that property on a corporation, the income tax on property sales if it's on your name or if it's on a property corporation, and the real estate transfer tax that is called over here the ITV. I know this is quite dense subject, but due to the short time, I'll try to go through to give you just an overlook. Okay, so if there are a couple of benefits in Panama as well, you have a lot of taxes, but there's some benefits as well. If it's a first home, a property that is acquired as a first residence and classified as a family tax heritage or first residence, there will be a cadastral value between 120 and 3,000 maximum. That will be exempt from taxes for 3 years. This exemption period will start from the date of the issuance of the occupancy permit of the date of registration in the public registry, whichever comes first. Also, on the property of a disabled person through law, the primary and permanent residence of this person with a value not exceeding at 250,000 is exempt, provided that the title is in the name of the disabled person. So taxes on a property are assessed annually and are due payable in 3 equal installments due on April, August, and December. If the total annual tax is less than $10, it must be paid in one single installment. I don't know if many properties nowadays are without that benefit. Advance payment discount. There are also discounts if you pay your taxes that are assessed annually at the beginning of the year. So there's a 10% discount. It applies to any real estate property, land, commercial premises, any type of property, and is valid only if you pay it by April 30th of every year. So, talking about the property tax, in 2019 there was the introduction of two new concepts of how to calculate the tax for the property. So there's a combined progressive rate for the family tax heritage on the first residence if you were to register the property as a first residence. There's a table, but it's not divided on whether the value of the property. It's actually, you have to consider the first $120,000 of the property value is exempt. Anything more than 120,000 and up to 700 of that same property will be calculated at 0.50%. So that bracket of the value of the property will be paying $2,900 a year. Anything exceeding 700,000 on that same property will pay the amount considered on 0.70%. So there's a calculation to be made. Yes.
Okay, so if it's 800,000, then the 0.7 is paid between the 7 and 800,000.
Yes. Let's say it's a property on 800,000. You would take 100,000, multiply it by 0.70%, and add it to the 200. Yes, the 2,900. Exactly right. So you can see the difference on the rates on this scenario and this scenario. This is a property that is not registered as part of the family tax heritage, and you can see that the rates are very different. The bracket exempt is only up to 30,000. The next bracket is between 30,000 and 250,000, and it's 0.60%. The next one is 0.80%, and so on. So that's where you would see the difference of how to calculate the tax for the property. So real estate sales. By law, since 1974, there's a 2% rate created that applies to any form of transfer of title of real estate. That would be with certain exceptions. Donations through some regulations are exempt, but every other transfer has to pay 2%. 2% of the sales value. Now there's another catch over here. So this 2% transfer tax, there's two ways of calculating it. You can pay it upon the value agreed of the sales, or this is a calculation we would have to do, that the official value on the date of acquisition for the seller, plus the value of any declared improvements, if there are any, and then calculating a 5% increment yearly for every full calendar year elapsed between the date of acquisition and the date of the transfer. Now, whichever of these two scenarios yields a higher number, that's the number that the government will take into account to calculate the 2%. This is an example of how to calculate it. Let's say this is a property with the official value of $390, and the sale is for the same amount, but the property owner has had this property for 11 years. Then you would multiply this 11 for 5% increase. That will give us a 55%. 55% on the cadastral value is an increase of 214 and something. So you add that and then calculate the 2%. That's how much you would have to pay on the transfer taxes. Income tax on profits from the sale of securities of shares for capital gains. If you have a property that is owned on a corporation and you decide that, because there are some cases that it's better either for the seller or the buyer to, instead of selling the property, you can sell the shares on the corporation, then you would have to pay taxes on your capital gains. So that's an entire different scenario with another calculation. These are the exceptions for the real estate transfer tax. Donations when they're between first-degree blood relatives, donations between spouses, and any other special laws. And I'm quite sorry, I know maybe this presentation will leave you with more questions than answers for the scenarios, but I know that it's quite brief the time we have. Yes.
About 2 slides back,
Yes.
is what you're saying, that you're essentially paying tax on an unrealized gain, is that?
On this one?
From this, yeah, because that doesn't seem very cool if that's the case, but I'm curious.
So in the first one, the value was 390. 11 years later, it sold for 390, so there was no appreciation, no equity build. But it's being taxed as if there was equity built.
Yes, because it's supposed to be an increase on equity build. Because we tend to think of properties to be valued rather than depreciated. And in this case, you see that the official value, the person is selling it for the same amount.
So they didn't make any money.
They didn't make any money in this case, but it's not the usual situation. But this is kind of just to portray the how to calculate it. The most usual situation is you bought it for 195 and you're selling it for something else, for a bit more at least, and then you do the calculations and then the 2%. So there are some other ways to pay tax on the property sale, but it also depends on the situation. This is a very highly complex calculations, and we thought maybe this was the easiest way to portray the complexity, but there are other taxes as well and different routes to go through. Like for example, there's another situation where you do this calculation and then you compare another one where you can maybe input all the expenses that are involved in the sale and you compare which one is best for the situation. So there are alternatives. And the best way is to take each case into account and analyze each one as independent.
Thank you very much.
Yes.
Information people ask us to gather from this trip, so
Yes,
I appreciate that. Thank you.
And I understand probably you would like to take our number. If you have any more questions, we're of course very likely to want to help you out and welcome you as well in Panama.